Hello and welcome to topic 5. We will be talking about statement of financial position. So our learning objectives from this topic is to explain the concept underlying the statement of financial position. We will be preparing classified statement of financial position, also called as SFP. We'll apply the disclosure techniques for financial statement information, and finally look at some of the differences between SFP and balance sheet. So your statement of financial position basically is your balance sheet, is another name for this financial statement. So what this represents is the business assets, their liabilities and equity as of a specific date. Now this is the only financial statement that is permanent in nature. So right from the first day that the business started up until your financial reporting date, all the information that you see on this financial statement is comprehensive, it's cumulative. Okay, so your statement of a financial position, also called as balance sheet, will give the readers the information about the liquidity and solvency of the business. That is the business's ability to pay their short-term and long-term maturing debt. What is the company's financial structure? What kind of assets do they have? How much liability or equity do they have? Okay, what's their financial flexibility? Does the company have ability to pay their debt? Okay, so one of the things that we do check in terms of the assessing the creditworthiness of the business is their ability to service their debt or to pay their maturing debt, and we check that through a debt to asset ratio. So these are some of the goods and bads of your statement of financial position. So the usefulness is the company that you are evaluating the company's capital structure. So knowing how the company, what type of assets do they have, how much liabilities they got, what type of shareholders equity they have. Okay, so that is the capital structure for the business. How is their rate of return on the assets that they have purchased? So this information can be used for checking the short-term ability of the company to pay, which is the liquidity, and the long-term ability of company to pay the maturing debt, which is the solvency. Solvency is looking at the longer-term time horizon. Financial flexibility, on the other end, is the company's ability to respond to opportunities or to unexpected needs for cash. So So you have, let's say if the company already has a lot of liability, okay, in comparison to the debt that they, in comparison to the assets that they have, then they would have lower financial flexibility. Okay, so some of the limitations of these financial statements. So with some of the limitations of this business, so many assets and liabilities are stated at historical cost, and this is something we had discussed in past. So the cost of your asset is what we will have the assets recorded at. Although the fair value of those assets would be more relevant information. So the other limiting factor when it comes to statement of financial position is the use of estimates, or also called as soft numbers. So if you think of your property, plant, equipment items, those items have estimated useful life, estimated salvage value, or the residual value. So there is a fair bit of estimated numbers that are used in the process when these financial statements are prepared. So the statement of financial position does not report items that cannot be recorded objectively, such as your internally generated goodwill. So when it comes to the classified statement of financial position, this in a nutshell is what your financial statement will look like. So on one side, we have our assets. On the other side, we have our liabilities and equity. So at any given point in time, your assets have to equal your liabilities plus equity. So your assets or your items are classified based on similar nature. If they have similar homogeneous items, then they will be put together. Okay, so it will allow the users to assess the amounts, the timings of the future cash flow, the uncertainty that the business is facing, what's their liquidity, what's their financial flexibility, what's the profitability, is there any risk associated to that. So users can look at this financial statement to run a whole lot of ratio analysis to understand what the business is doing and how they are performing. So when it comes to classification of items on statement of financial position, we usually go with the grouping based on your monetary asset and financial instruments. So the assets that are different in their type or expected function, such as your inventory item, is different than the capital item. So inventory becomes a current item, your capital item becomes long term. Likewise, your liabilities, if they are paid in the short duration, then they become current. If they are paid over longer time horizon, then they become long term. So your assets and liabilities with different liquidity characteristics. So if you think of your statement of financial position, all the elements on your SFP are listed in the order of liquidity. Liquidity is how quickly can you convert that item to cash. Okay, so if you think of your current asset section, the first item would always be your cash account. So your assets, liabilities, and equity with characteristics that allow for easy measurement or valuation. So generally, these are the guidelines we follow in order to report our items or transactions on statement of financial position. So getting into the current asset, now, before we get into the current asset, we got to understand that asset is something that a business owns. Something that a business owns, they control, they have the right to use this, right? Now, there are two things when we are looking at defining whether your asset is current or long-term. We need to look at 1 year from your financial statement date and your operating cycle. When we compare those two items, we will take the longer of those two to judge whether your item should be current asset or not. Now, what's an operating cycle? Operating cycle, this is the pictorial representation that you're seeing on the bottom right corner there. So the operating cycle, basically, we also call that as cash to cash cycle. So the time that the business spends between spending cash and receiving cash. Okay, so that is the time they moving from your raw material up until the time your product is sold. What's your operating cycle? Okay, so converting cash to cash. So we will consider the operating cycle and compare that against 1 year. Whichever is longer, that will determine if your transaction is current asset or not. The same idea applies to your current liabilities as well. Okay, now all of these current assets, as we just mentioned, will be recorded in the order of liquidity. All items on statement of financial position, not just the current asset, but all items on statement of financial position are listed in the order of liquidity. So your current asset, the first element on that class is always your cash and cash equivalents. Cash is cash. Cash is what you have in the bank, the checks that you have, currency, coins, any petty cash that you have, that is your cash. Your cash equivalents is something that is highly liquid investments are considered as cash equivalent. An investment which will mature within 90 days from your financial statement date is considered as cash equivalent, something that is not quite cash today, but is very close to it. Your short-term investment in any debt or security. So if the company does have spare cash and they decide to buy debt or security instruments of another businesses, and the intention is to hold them for shorter term, and we are still applying that criteria of taking longer of 1 year or the operating cycle to determine. So if the intention is to sell these investments in the near future and not hold them till long time, then it becomes a short-term investment and it will be listed after your cash. So these can be your held for trading items as well, which are typically listed at fair value. Now, there are a bunch of different receivables that we do come across. Accounts receivable is one of the most common type of those receivables. It depends on who that receivable is from. Depending on who it's from, we can go ahead and determine the name for the account. So if your receivable is the money that is owed to the business by the customer, then we are looking at accounts receivable. If the money is owed by the related parties, then it will be a related party receivable. You could also have some unusual items that are reported. So we could have trade receivables. So trade receivable is the receivables that come into play as part of the business transactions or operating activities, such as your accounts receivable and notes receivable that came into effect as part of the business operations. Now, there will be separate disclosure that is required if any of your accounts receivables are pledged against collateral as collateral. So generally they are accounts receivable, but if you have any other types of receivable that are pledged as collateral, then you will have to disclose that in the notes to your financial statements as well. So the receivables, accounts receivables are always listed at net realizable value. Inventory. Now, inventory is an asset that the business manufactures. So if they are manufacturing business, then they would come up with the inventory. The intention is to sell that and make money. Okay, so inventory is always held for sale in the ordinary course of business. So in the process of production, such as for sale, in the form of material or supplies to be consumed in production process or rendering services. So with the inventory, the intention always is to sell those inventory items and make money. Now that inventory can exist if it's a manufacturing business, then the inventory can exist in 3 different stages. It can be raw material, it can be work in process, or it can be finished goods inventory. So 3 different stages and 3 different costs associated to those inventory items. So when we are valuing the inventory, one of the things we have to consider is at the end of the year, we have to apply the rule of lower of cost and net realizable value, also called as LCNRV. That's what we are talking about here in the middle there. So valued at lower of cost and net realizable value. So we compare the book value of your inventory against the net realizable value. At any given time, we have to make sure that our inventory is listed at the lower of those 2 numbers. Our cost of inventory during the course of business can be determined using the first in, first out method, specific identification, or weighted average cost formulas. Prepaid expenses. So this is pretty much all we have in the current asset section. So the prepaid expense is something that the business has paid in advance, but the benefit out of that is not being used up. So the benefit tends to be over a longer period of time. Generally happens with the items such as your insurance, rent, advertising, supplies. So let's say if we are talking about insurance. The general practice is to pay your 12 months insurance premiums on the first day of the covered period. So if your insurance policy is from January to December, then on January the 1st, we pay the insurance premium for 12 months on that day. So it becomes a prepaid asset or prepaid expense where the company has paid for the item, but the benefit out of that is not yet utilized. So that benefit will be covered over the 12 months period. So your non-current assets are also called as your long-term assets. So the sub-item or the subsection in that is your non-current investments. So non-current investments or your long-term investments, they normally consist of investment in the debt or security or the sinking funds that the business has set up. Now, remember earlier on, we said if the businesses do have spare cash and they end up buying debt or equity security of another businesses, then it becomes an investment. Now, depending on businesses' intention of whether they want to hold these investments for short-term or long-term, either you could see these investments under the current asset section. If the intention is to hold them on a long-term basis, then you would see them in the non-current investment, which is here. Sinking fund is a requirement. So sometimes the businesses are required to set up a fund in order to mature a liability. Okay, they just have to put the money aside, and this money cannot be used for anything else. So that is a sinking fund, and it becomes a non-current investment then. The options available for valuation with the non-current investments, the most common one is the amortized cost. Okay, amortized cost, or the cost, is what we will have our investments at. Um, the other options available is the fair value, which is the market value of those investments. So the accounting standards do allow for that. And then the other alternative is equity method. Some of these are a little advanced concepts that will be discussed on either later on in this chapter or in the following courses. So with the property, plant, and equipment. So property, plant, and equipment consist of assets that have physical substance. So assets such as your land, building, equipment, machinery, tools, okay? Any asset that has life of over 12 months, and that asset has to help you generate revenue. Right? And when we call it asset, it is implied that the business does have rights and can control that asset. They can choose what they want to do with that asset. So these are your physical asset. They have to support your ongoing operations. They have to help you generate revenue. So these assets are reported at historical cost. Okay, so amortized cost, if you think of your asset is reported at historical cost. But right underneath the asset, you will also see a line for accumulated depreciation. Okay, and then you see the net asset onto the books. That is your amortized cost. Your cost of the asset is spread over its useful life. Now, under IFRS guidelines do allow us to revalue these assets at fair value. So that is a company's choice. The company can choose to keep their capital assets on the historical cost principle, or they can choose to go with the fair value model. Anytime we are looking at the tangible assets, except for land, all the other assets have to be depreciated. Land is the only asset that has physical substance but doesn't have any fixed life, so we are not able to depreciate it. But all the assets have to be checked for impairment. Impairment is the loss in value. So what we do there is we will compare the carrying value of those assets against the fair value. So if the carrying value is higher than the fair value of your asset, then you're looking at impairment, which means your asset is overstated onto the books. And now we will have to bring that asset down to the fair value. Okay, so all the assets have to be tested for impairment. So opposite of your property, plant, equipment is your intangible assets. So your intangible asset has the similar idea. These are also the asset that is helping the business generate revenue. They are helping you earn money, and the life of these assets is over 12 months. So the idea is the same, but these assets do lack physical substance. Your property, plant, equipment items do have physical substance. So if you get awfully upset with somebody, you can throw those items at somebody and hurt them. But you can do the same with an intangible. They lack physical substance. So items such as your patents, copyright, franchises, trademarks, trade names, these are all different types of all different types of intangible assets that exist. The other slight difference when it comes to the intangible asset is that some intangible assets would have finite life, and there could be some that don't have any have indefinite life. We cannot put a number on that. So if it does have finite life, then we will go ahead and amortize those assets over their useful life. But in the event that these intangible assets don't have finite life, they have indefinite life, in that case, we are not able to amortize them, which means we will have to check them for impairment. All the assets, as we said earlier, are checked for impairment. Now, goodwill is not part of your intangible asset. Goodwill comes after intangible assets, and the companies can only record goodwill when they are acquiring new business. So goodwill is the difference between the money that we are paying to acquire another business minus the fair value of all the assets that we got. So if you paid more in comparison to the fair value of the assets that you got, then the difference is an added benefit, which is then called goodwill. So goodwill can only be recorded when the business combinations happen. This will not be amortized because it doesn't have a finite life, but it will be checked for impairment. The other thing to keep in mind is that the businesses cannot record internally generated goodwill on the books. Goodwill has to come from a business combination. Otherwise, you cannot take the internally generated goodwill on the books as an asset. The other types of assets that don't sit in those categories can be your assets in special funds, non-current receivables, deferred income tax asset, which is discussed in Accounting 350, which is the intermediate financial accounting course 2 that follows this one. We have property that is held for sale and advances to subsidiaries. When it comes to the long-term assets, the companies are expected to disclose enough information about these long-term assets with regards to what type of depreciation policies were used, what was the residual value, what's the estimated life, the amortization schedules. All of that information has to be disclosed in the notes to your financial statements, so your user has that information available. The other side of your statement of financial position is your liabilities and shareholders' equity. Now, when you're thinking of your statement of financial position, always easier to think of this as a T account. On the left-hand side of the T account is your asset account, which is all of your assets we talked about, current assets, property, plant, equipment, non-current investments, as well as your intangible assets and goodwill. Okay, so now we're looking at the right-hand side, which is your liabilities and shareholders' equity. At any given point in time, your total of assets has to be equal to your liabilities plus your shareholders' equity. Now remember, when we were talking about our current assets, we said we are going to look at the longer of 1 year from the 1 year from the last financial statement date and the operating cycle. That same criteria applies here as well. Once that is determined, we will use that same information or idea to determine whether our liabilities are current or long-term. Okay, before we get into the details of the liabilities, what a liability is this is really something that the business owes. A liability is a transaction that needs to have a past transaction. There is a present obligation, and in future this will be settled. Whenever these liabilities are settled in future, this will reduce your asset in most cases. Whenever you pay a liability, you pay your accounts payable, let's say, you are debiting accounts payable and crediting cash. So your asset goes down in most cases. So your liability is something that will have past, present, and future. If any of those is missing, then it's not a liability. Okay. Then apply the 1 year or the operating cycle rule to determine whether that's current or long-term. Anything that's not current automatically becomes long-term. So the current liabilities are items such as your payables that are resulting from acquisition of goods and services, such as your accounts payable, your collections received in advance for the delivery of goods or the performance of services. This is your advance payment or your unearned revenue or deferred revenue. Other liabilities to be paid in the short term. So if you have any employee wages to be paid, that is your other liability. It's not part of accounts payable. Your short-term financing payable on demand that was borrowed on line of credit, and your derivative financial instrument. So when it comes to your current liabilities, your accounts payable normally is the first account that is listed, but otherwise there is really no order. But when we were talking about our current liabilities, your current assets, we said there is the order of liquidity. So cash, then the short-term investment, then accounts receivable, so on and so forth. So that was your order of liquidity. We don't have the same thing in your current liabilities. Non-current liabilities, as we stated, anything that is not a current liability then automatically becomes a long-term liability where the payment is expected over a longer time horizon. So three types of liabilities can exist in that. One, coming from a special financing situation, such as your bonds payable, where the company has taken bonds liability. Okay, they have issued the bond, so there is bonds payable liability sitting on the books. So that is a long-term liability. It can be an ordinary operations of the business. It can be originating from the ordinary operation of the business. So your employees are working for you and the company is issuing pensions. So that pension obligation becomes a long-term commitment. Okay, and this pension obligation, the accounting for pensions is discussed in Accounting 350, which is the second intermediate financial accounting course following this one. Then we could also have obligations that are arising from ordinary business operations that are contingent on future events, such as your product warranty. Okay, now when you are looking at your long-term liability, let's say, for example, your long-term liability is a mortgage. Now, when you're looking at your mortgage, technically speaking, your mortgage is a long-term liability, so it should show up in the non-current liability section. However, because there is a payment made and the principal is paid as you go, any portion that you will be paying in the next 12 months from your financial statement date then becomes part of your current liability. So some of these long-term liabilities could have a current portion. So in that case, we will have to take our total mortgage, uh, take out our piece for the current liability, which will be paid in next 12 months, and then the remainder becomes your non-current or long-term liability. So the addition of your total current liabilities and total long-term liabilities will be your total liabilities. And then we have our shareholders' equity. Now your shareholders' equity has few different sections. There is capital shares. Capital shares is the place where you will see all the details with regards to your shares. The shares that were issued by the business, whether these are preferred shares or common shares. So we will see the number of shares that are authorized, how many shares are issued, and what the total value of those shares is. What is the total the money that came in, the share capital. So when these shares were issued, how much money came in? That's your share capital. Okay, so different types of shares will be listed here. And we have to disclose the authorized, issued, and outstanding shares in our shareholders' equity. The contributed capital is generally reported as a single item, and this will include your share premiums. Your AOCI, as we call it, is accumulated other comprehensive income. Now, remember, when we were talking about statement of comprehensive income in the earlier topics, we said there was a concept of other comprehensive income. That other comprehensive income was the temporary account. The balance in that other comprehensive income then is closed out to this permanent account called as accumulated other comprehensive income, or AOCI. So AOCI is cumulative other comprehensive income, which will house all of the unrealized gains on losses on fair value through OCI investments. Okay, we will look at FVOCI investments in the investments, which is the last topic for this course. So we'll discuss it in detail there, but that is what the FVOCI investments. So any unrealized gains and losses on those investments will be recorded under AOCI. And then we have our retained earnings, or a deficit. This is the amount that is undistributed or accumulated earnings or losses from the first day the business started. This is shown as a single line item. So that is with regards to the details when it comes to your statement of financial position and all of its elements. Now, when it comes to the disclosure to the financial statements, there is quite a lot of disclosure requirement. So under ASPE, there is a term called as contingencies, and the same item is called as provisions under IFRS. So basically, these are material events that have uncertain outcome. Okay, the outcome of these transactions is based on a future event. So those are your contingencies and provisions, which has to be disclosed in your financial statement notes. The contingent gains are not recognized under IFRS or ASPE, but you will have to disclose that as notes. There are some contractual situations. If the company does have contractual obligations, then those contractual obligations have to be disclosed in the notes to our financial statements. And if we have any commitment that requires a specific action, such as maintaining a working capital, then that has to be stated as well. For example, if the bank requires business to maintain a certain level of working capital, the working capital is your current asset minus current liability. So if the business is required by the bank to maintain a certain level of working capital, then it has to be disclosed in the notes to your financial statements. Likewise, the accounting policies that the business has used, such as the first in, first out, specific identification, was the LCNRV applied, all of that information, the perpetual system or the periodic inventory system. So all of that information has to be indicated in the notes to your financial statement, and the estimates the business is using when they're looking at the capital assets. What were the useful lives? What were their depreciation schedules looking like? How did we come up with the residual value? So all of that information is stated in the notes as well. Then we have subsequent event. Subsequent event is the further evidence to a condition that exists. Okay, as of today, do we know of anything that will affect the future period, but the transaction is as a result of the past? Okay, so if we know of any subsequent events, then we have to state that. Okay, now when we are preparing the financial statement is for the prior year. At that point in time, we might not have known that information. But on the date that you're preparing the financial statements, if a new information comes to play, or you know of something that will impact the business, then it has to be disclosed. That is subsequent event. And if you have any other additional details, then that has to be disclosed in the notes as well. Now, how do we make the users aware of that information? It really depends on the type of information. The most common way of making this information available is through the notes to the statement of financial position, where you get lots of details on the notes and the financial statements. But if there is quick and dirty explanation, or if you want to say something, then you can put the parenthesis explanation right on the face of your financial statement or in the body. You can throw an asterisk there and disclose the note right at the bottom on the same page. You can do the cross references, or you can do the supporting schedules. So there are a lot of different ways that you are able to provide this additional information to the users. And finally, that is a quick IFRS and ASPE comparison with regards to what we have talked about. That is all I have for this topic, my friends. Thank you for listening in.